All right, now, okay, this is probably the most important line item, the most important thing. When we're evaluating apartments, we need to figure out what the NOI is. What the NOI is, net operating income. This is our bread and butter. This is the lifeblood of the business. This is what makes everything tick, okay? The net operating income simply is the income, the effective gross income, minus the expenses, the operating expenses, not the debt service, just the cost to operate the building, okay? That number is going to be our net operating income. That number is so critical to us. That number defines our value, defines the value of the property. Okay? If we pay, look at it, we pay cash for a building, right? No mortgage. The net operating income is our capital. That's what we're putting into our pocket. Right? So we need to know that number because that number determines our cash flow, determines our value. And if we do have a mortgage, that's the money we're going to pay our mortgage with. Now, if we've done our homework right, it's a good property, there's going to be something left over afterwards. That's the goal. That's what we want. Okay, but just understand, this number is very critical. We don't want to, you know, there's a lot of people that look at just the gross income. You guys ever heard of the gross rent multiplier? It's a common tool used just like cap rate, capitalization rate, to evaluate the value of a property. It basically looks at the gross rent of a property as it relates to the purchase price of the property. The thing that the gross rent multiplier does not take into account is the expenses in the net operating income. The reason why the expenses are critical is because every building is different, okay? You guys, feel free to jump in here. What's the big difference of a building that is master metered, that means the landlord pays for the PG&E and the water and the gas and all that stuff, versus a building that's individually metered, the tenants pay the PG&E and their utilities. What do you guys think is the big difference between those two buildings? Somebody jump in.
Save more money because the tenants, when somebody else is paying for it, they tend to use
right.
because they don't, have to pay.
That's right.
When they have to pay, they tend to reserve. So
that's right. If somebody else paying for it, we'll leave the light on. We'll let that heater go. Right? When you're paying for it, you're gonna think about it. Okay? And I bring this up because the NOI is critical. The net operating income is critical. We don't so much, when we're looking at our properties, I don't do a lot of business in San Francisco, which I like to. We're looking at more than NOI, the net operating income, the cap rate. And the simple reason is because now that's going to take into account the operating expenses. That's going to give us the NOI number. Okay? And that number, again, if we pay cash, that's our cash flow. If we got a mortgage, that's the money that we pay our mortgage and what's left over, that's what we put in our pocket. Also, that number directly affects the value